Okay, let's unpack this. Because usually when we talk about investment funds, we're strictly looking at the numbers.
Right, the returns, the volatility, all the usual suspects.
Exactly. But today we're looking at something that feels a bit more like a Swiss Army knife of finance.
That's a great way to put it.
It's called the Valoris Capital Markets Fund.
And it is a fascinating case study
Mm.
because on the surface, it's a robust investment vehicle. But if you look deeper, it's really designed as a strategic tool.
A tool for what? Exactly.
It creates a bridge between, say, global market exposure and also specific residency eligibility in Portugal.
Right. So it's offering a dual benefit. You're not just parking capital, you're potentially unlocking a whole lifestyle change.
Hmm.
So I guess the mission for this deep dive is to figure out how this fund balances those two very different goals. It's an open-ended fund managed by Magnify Capital Partners. So how does it actually work?
So that open-ended structure is key here. It gives investors flexibility. It doesn't lock them into a rigid timeline like you might see in, say, private equity.
Okay.
But what really makes Valoris distinct is that it offers two completely different tracks or portfolios, depending on what you, as an investor, actually need.
A choose-your-own-adventure setup, then. Let's start with the first path. They call it the moderate portfolio.
Exactly. And you should think of this as the debt-focused option. It's constructed very specifically to align with local compliance.
How so?
Well, to do that, they allocate 60% of the portfolio to Portuguese corporate debt.
Okay, so that covers the compliance part of the equation. What about the other 40%?
The remaining 40% is in diversified global fixed income. So the goal here is really capital preservation and stable income.
Got it. So it's for the more risk-averse investor who wants to protect their principal while ticking those regulatory boxes.
Precisely. And looking at the data, it's managed an average annual return of about 3.99%.
Which is solid for a defensive strategy. But then there's the second path, the enhanced portfolio. And this is where things look a bit different, right?
Oh, very different. This is absolutely for the growth-focused investor. The allocation flips to 80% global equities and only 20% international fixed income.
So it's designed purely to capture market growth.
That's the idea. And looking at the breakdown, it's heavily weighted toward the U.S. market. I think it's about 72% exposure there.
Wow. Okay, so an aggressive, globally diversified stance.
And the performance reflects that higher risk tolerance. It's been bringing in an average annual return of roughly 13.35%. So you have one vehicle, but two very different speeds.
Now, this is where it gets really interesting for me. I noticed they use the term passive investment strategy. Usually when I hear passive, I just think average returns.
Right, boring.
Yeah. But you're telling me there's some pretty heavy-hitting academic theory behind this.
It's far from boring. It's actually quite sophisticated. See, Valoris doesn't try to outguess the market with active trading.
Which, as we know, often just leads to higher fees and lower performance.
Exactly. Instead, they've partnered with Dimensional Fund Advisors, or DFA.
And DFA isn't your average investment firm.
Not at all. They are leaders in what's called evidence-based investing. Their entire approach is rooted in Nobel Prize-winning research by economists like Eugene Fama and Kenneth French.
So what does that actually mean for the money in the fund? How does it play out?
It means they use something called factor investing. So think of a factor as a characteristic of a company that historically leads to higher returns.
Okay.
So instead of just buying the whole haystack, like a standard S&P 500 index, they systematically overweight the parts of the haystack that actually perform. They target small cap stocks, value stocks, and companies with really high profitability.
I love that. So it's not just following the market. It's trying to capture the most efficient parts of it, all based on decades of data.
Precisely. It brings this institutional-grade academic rigor to what could have just been a simple compliance vehicle.
We should probably also talk about the people steering the ship. Who is actually managing this fund?
You've got a very seasoned team at Magnify Capital Partners. There's Pedro Ortegon Correa, who brings experience from Merrill Lynch, and João Barata, who was formerly with ABN ARO.
So people with serious institutional backgrounds.
Absolutely.
And on the boring but important side, what about regulation?
It's fully regulated. The fund is registered with the CMVM, which is the Portuguese Securities Market Commission.
Okay.
And for any of our American listeners, there is a crucial detail here. Both portfolios are USA FATCA compliant. They're also classified as QEF elected PFIC.
Which, if we translate that from accountant speak, means it avoids a lot of the tax headaches usually associated with foreign investments for U.S. citizens.
You've got it. Without getting too deep into IRS code, that QEF election essentially neutralizes the punitive tax rates that are usually applied to foreign funds.
Yeah.
It treats the earnings much more like a standard domestic investment.
So when you put it all together, what does it mean? It really seems like Valoris is trying to be the best of both worlds.
I think that's the key takeaway.
You get the Portuguese regulatory alignment with that moderate portfolio, but you're also backed by this world-class, Nobel-level investment theory through the DFA partnership.
That's it. Valoris treats the capital seriously. It applies rigorous financial principles whether you are in the defensive moderate bucket or the growth-heavy enhanced one.
It's refreshing, really, to see a product that works as a financial instrument first and a bureaucratic key second.
It certainly raises the standard, and it leaves you wondering,
Yeah.
well, if a fund can offer this level of financial sophistication and tax efficiency, why aren't more of these administrative investment tools designed with this kind of rigor?
That is a great question to chew on. Thanks for tuning in to this deep dive on Valoris. We'll catch you next time.